Hello, welcome all to the today's live session on the CS Executive Tax Laws, Tax Law and Practice, where in today's session we are discussing about the concept of the old tax regime versus new tax regime. Very important and very trending topic, and there is a lot of changes that have happened from financial year 22-23 to 23-24, for which the exams are going to be appearing for students who are appearing in June 2024. So there were two concepts. One is the existing tax regime, and in the recent past, around 3 years back in 2020, the finance minister came up with a new tax regime concept. So the new tax regime concept enabled or started with its footprints in 2020. And then from then onwards, we have the following the new tax regime. And the new tax regime got the second version or 2.0 version, or new tax regime 1.0 was effective till from 2020 till 2023, that is 22-23 financial year. Now, moving forward from 23-24, there is a new tax regime version 2.0, which is being effective. So let's deep dive into understand what are the differences between the old tax regime, new tax regime, and is it applicable even now, or is there any changes in terms of the new tax regime version 1 versus version 2? All of that we'll discuss in today's session. So let's deep dive. So we have this old tax regime versus new tax regime. And first, let's spend some time on understanding the concepts in one by one. Okay. Now we have what is old tax regime. Let's understand certain concepts in terms of the old tax regime as to what is old tax regime. Like I said, in Finance Act 2020, we had this first time that they came up with a concept called alternative taxation regime, which was introduced by way of having a new section in place, which is known as Section 115 BAC. Okay, 115 BAC, and this was applicable for individual and HUF, which was further extended, or which was further this alternative tax regime was extended to the association of person, body of individual, and the artificial juridical person by Finance Act 2023. That means this was initially, now like I said, the new tax regime 1.0 versus 2.0. The 1.0 was only applicable, 1.0 was only applicable to individual and HUF. Going further in Finance Act 2023, this was made applicable, or the applicability was further extended to the other three more category of people, that is the artificial juridical person and association of person and body of individual. So having understood when this came into picture, and the section number is 115 BAC, most of the times in the question paper, these kind of sections only are mentioned. They don't mention old tax regime or new tax regime, but they will mention the section name. Consider the provisions of section 115 BAC, or ignore the provisions of section 115 BAC. So there becomes very critical for us to remember the section 115 BAC. Now moving further in terms of what does old tax regime look like, or what does it mean for all other purposes, the computation is very important. Like I said, the computation of total income and income tax under the normal provisions of the Income Tax Act without giving effect to section 115 BAC is commonly referred as old tax regime, or OTR in short. That means when some provision or one new section or new alternative tax regime has been brought into picture. Now, when I say that, that old tax regime or the new tax regime or the old alternative tax regime which was brought into picture is known as the new tax regime. Having said that, what happened, what is known as old tax regime is something which is without giving the applicability or implications or changes that are brought into picture in terms of the 115 BAC will be considered, or the erstwhile provisions which was there from 1961 till now with the changes in the certain smaller provisions, all of that will be considered as the old tax regime. So computing the income in provisions or in line with the earlier existing tax provisions is called as the old tax regime, without giving the implications or adjusting, or without giving any effect to section 115 BAC is called as the old tax regime. So this is a next point of understanding in terms of what is old tax regime. Under old tax regime, the income tax on total income is calculated at the rates prescribed under Section 2 of the applicable Finance Act. Now, we all know that the rates are given in the Finance Act. The tax rates or the rates of tax are referred in Section 2 of the Income Tax Act, wherein Section 2 says that as prescribed or as mentioned as rates prescribed or rates in force under Finance Act. What are the rates in force? Rates in force are usually given by the Finance Act. So the flow of thoughts now here we are moving further. How is the income tax is being calculated? Income tax on total income, or how is it being computed? It is being computed based on the rates prescribed under Section 2 of the applicable Finance Act, which is the first schedule of the Finance Act. Is something that we all know that the rates mentioned in the Finance Act in the first schedule, as apart from the rates mentioned under Section 111A, 112, 112A for the purpose of capital gains that we all know. Apart from that, every other basic rates or the tax regime rates, the old tax regime, the new tax regime, the slab rates, all of that is given in the Finance Act first schedule. And this is coming through the Section 2, the driving force. The applicable tax rates is usually mentioned as that the rates in force. The definition of rates in force is defined in Section 2, which is leading to the Finance Act. Now, this is all 3 points put together is called as the old tax regime. What is old tax regime? Quickly to summarize, the alternative tax regime was introduced under 115 BAC. Now, which was further extended to the artificial juridical person, AOP and BOI. Apart from this, something else that was there is called as the old tax regime. What is being followed without giving the effect of 115 BSE is called as the old tax regime. What was introduced was the new tax regime, and without following the conditions mentioned in new tax regime, whatever is being followed is considered as the old tax regime. And in the following the rates mentioned under the erstwhile provisions like Section 2 and Finance Act 2000 or the Finance Act first schedule. Now, going further, let's quickly see what is new tax regime then. The new tax regime, let me quickly read or mention the transcript as mentioned by the finance minister in the budget speech 2020. The finance minister in her budget speech of 2020 exclaimed means she claimed that old tax regime is riddled means she herself goes on to say that there is a lot of complexity, there's a lot of challenges with various exemptions and deductions which make compliance by the taxpayer and administration of the Income Tax Act by the tax authorities a burdensome process. So she herself admits and accepts that there are a lot of complications, lot of provisions, lot of deductions, lot of exemptions, which is making the life of taxpayers and the tax authorities a worrisome life. So in order to reduce that, it is also, she continues to say that it is almost impossible for a taxpayer to comply with the income tax law without taking the help of professionals. So she knows that in case of old tax regime, there's a lot of confusion, there's a lot of complexity, which needs a taxpayer should go to a professional and take the help of the professional. In order to provide, so she gives the background why she is bringing the new tax regime, and she continues to say that in order to provide a significant relief to individual taxpayers and to simplify the income tax law, a new and simplified personal income tax regime was introduced under Finance Act 2020. So she coins the new regime as new and simplified personal income tax regime under Finance Act 2020 by introducing a new section or a new provision, which is known as Section 115B AC. Finance Act 2023, now from 2020, further expanded or further extended the coverage of Section 115 BAC to the other people, and little other provisions have been changed. So let's look into the 1.0 version versus 2.0 version of the new tax regime shortly. Okay, this is commonly referred to as the NTR, new tax regime. So OTR is something called as old tax regime and NTR is the new tax regime. So going forward, wherever I refer as OTR, it is old tax regime. Wherever I refer NTR, it is new tax regime. Okay. Moving further, what else is new tax regime? Okay. Under new tax regime, the income tax are reduced for the concerned taxpayers, provided certain deductions, exemptions, and set off of losses are foregone. So what they are telling, in the old tax regime, you were getting a lot of exemptions and deductions, which used to reduce your income, and then you pay tax at the regular rate. Now, they are continuing to say that you will get the benefit of reduced tax rates if you forego certain exemptions, deductions, and set off of losses. So that is the major characteristic. They said that if there is lot of exemptions and lot of deductions that are given, it will be very difficult for the taxpayer to calculate and comply with the tax provisions. Thereby, let us do away with all of that and get a simplified tax rate and a new and reduced tax rate. Apply that without taking any benefit of exemptions, deductions, and set off of losses. Okay, so if one has to claim the reduced tax rate, then he has to forego three things. What are the three things that he has to forego? He has to forego the set off of losses, he has to forego certain exemptions, and he has to forego certain deductions. He has to forego certain deductions. So all the three he need to forego in order to claim the benefit of new tax regime. Now, what was new tax regime version 1 and what is new tax regime version 2? First, let us see the applicability of these two new tax regimes. The new tax regime 1.0 was introduced by Finance Act 2020 as an alternative tax regime for individual and HUF taxpayers. Full stop. Only two people, individual and HUF. Individual and HUF only. Done. Individual and HUF only. And new tax regime 1.0 was applicable from assessment year 21-22 till assessment year 23-24. Thereby, we are continuing to apprehend the position that what we were studying till now was applicable new tax regime 1.0. What will be applicable from now onwards, that is from June 24 exam onwards, for students who are writing for financial year 23-24, that is assessment year 24-25, new tax regime 1.0 will not be applicable. So under this new tax regime 1.0, which was introduced in Finance Act 2020, was effective only for 3 assessment years. Assessment year 21-22, assessment year 22-23, assessment year 23-24. 3 assessment years it is applicable. Under and further, there was anomaly or the position or the perspective in which this was being handled was under new tax regime, the taxpayer can select or opt in to the new tax regime. Select means they can choose between old tax and new tax regime, and they can opt from old tax to new regime by selecting or making a preferential select of the option that is available while filing the return of income. So under new tax regime, the taxpayer can elect to opt in the new tax regime. Now, this was the sum and substance, the applicability of the assessment year 21-22 till 23-24, and the mechanism in which it was applicable was by way of opting in, by way of choosing in. Otherwise, he will continue to be under the old tax regime. If he do not prefer to opt in, then he will continue to be in the old tax regime. That is the meaning of opt-in. Okay. If I want to take the benefit of new tax regime, first thing is I'll have to set go the certain deductions and then certain exemptions and certain set off of losses. I'll have to forego all these things, and I'll have to make a declaration to the income tax authority telling that I don't want to continue with old tax regime, but I want to opt in or I want to go for new tax regime. So that is the express opinion. I will express the opinion or I will express the option that I am preferring to go for. So this is the new tax regime 1.0. In Finance Act 2023, the new tax regime 2.0 was rolled out. That means certain amendments were made into the new tax regime 1.0. So the Finance Act 2023 made new tax regime as the default tax regime for individual, HUF, AOP, BOI, and AJP. That means it extended. Earlier, it was applicable to individual and HUF. Now, it extends its applicability, not only restricted to individual and HUF, but it further goes on to give the benefit to the association of person, body of individual, and artificial juridical person. So this is one change, one amendment that they have made from 1.0 to 2.0. Further, new tax regime 2.0 is applicable from assessment year 24-25 onwards. Thereby, new tax regime 1.0 is end to assessment year 23-24. It is no longer going to be continued to be applicable in assessment year 24-25 because new tax regime 2.0 is applicable from assessment year 24-25. Now look at the changes. Look at the changes. Now, very crucially, you will have to look at it in terms of in new tax regime, always I was under old tax regime, and if I prefer to select or if I prefer to move from old tax regime to new tax regime, then I would need to opt in. I would need to opt in from old tax regime to the new tax regime. But look at the change that they have made here in new tax regime 2.0. In Finance Act 2023, they said new tax regime will become the default taxation system, default regime. So under new tax regime 2.0, the taxpayer now should go out from new tax regime to the old tax regime. Now they said you can continue to select, you can continue to enjoy the benefit of the exemptions, deductions, and set-off of losses. But if you want those exemptions, then you will have to go out from new tax regime. Automatically, you are under new tax regime. But if you want to enjoy the old tax regime, you will have to go out from new tax regime to the old tax regime. Thereby, it is opt out from the new tax regime that you will have to prefer. Automatically, you are under new tax regime from new tax regime 2.0. From Finance Act 23 onwards, automatically you are under the new tax regime. Earlier, automatically somebody used to be under old tax regime. They used to go from old tax regime to new tax regime by opting in. Now, automatically they are in the new tax regime in 2.0 version. They'll have to opt out from new tax regime to the old tax regime. So this is the fundamental differences, few of the basic concepts of new tax regime versus old tax regime. Moving further, what do you mean by the what do you mean by new tax regime 2.0 is the default tax regime? What do you mean by new tax regime? Default tax regime. Now here we need to understand that from financial year 23-24, relevant to assessment year 24-25 onwards, from relevant to assessment year 24-25 onwards, the taxpayers referred earlier above, that is, who are those individual, HUF, AOP, BOI, and artificial juridical person. Taxpayers referred are 5 different types of assessees or person. So who are those 5 different assessees, type of assessees? Individual, HUF, AOP, BOI, and artificial juridical person are mandated to compute. Default tax regime means they are literally required to go under new tax regime. That means mandated to compute total income and income tax thereon in accordance with section 115 BAC subsection 1A, unless they opt out of new tax regime 2.0. If they opt out, then they will go to the old tax regime. Thus, section 115 BAC is referred to as the default tax regime. That means somebody will automatically come under default tax regime, that is the new tax regime 2.0 version for financial year 23-24 onwards. If they want to enjoy the exemptions, deductions, and set off and carry forward, then they'll have to opt out of new tax regime and then they'll have to go further. Now, what is the financial year for which it is applicable? We quickly understood already, discussed this. Let me quickly summarize this again. New tax regime 1.0 begins from 1st April 2020, which is financial year 2021, that is assessment year 21-22, and sunsets, and the applicability of new tax regime 1.0 comes to end on March 31st, 2023, which is 23-24 or financial year 23-24, that is assessment year 23-24. Okay, assessment year 23-24. The financial year 22-23 is the last financial year, and it comes to end, that is the relevant assessment year is 23-24. The new tax regime 2.0 applies from 1st April 2023, which is financial year 23-24 onwards. That is assessment year 24-25 onwards, the new tax regime is applicable. So let me quickly summarize. 1st April 2020 till 31st March 2023. That means financial year 2021 till financial year 22-23. That is assessment year 21-22 till assessment year 23-24. Then the new tax regime shall be applicable from 1st April 2023, which is the financial year 23-24 onwards, which is relevant assessment year shall be assessment year 24-25. Now moving further, what are the further aspects that we need to understand? So let's move further to understand in terms of who are the taxpayers to whom this is applicable. So new tax regime 1.0 applies to individual and HUF. New tax regime 2.0 applies to individual, HUF, AOP, BOI, and artificial juridical person. So these are the 5 different assessees to whom the new tax regime 2.0 is applicable. What is this, the old tax regime happens after this new tax regime 1.0, new tax regime 2.0? What happens to the old tax regime? Is it all outdated? Is it completely not applicable? Let's see that what happens to this. Okay. Now, in case of the old tax regime, does it become redundant? No, we are telling no, it does not become redundant. Under new tax regime 1.0, one has to opt into the new tax regime. Those who do not opt in will follow old tax regime. That means by default, under new tax regime version 1.0, they were under old tax regime. If they want to new tax regime, then they will opt into the new tax regime. Under 2.0, under new tax regime version 2.0, one can opt out of the new tax regime. By default, they are in the new tax regime. They can opt out of new tax regime. Those who opt out will follow old tax regime. So this is the only difference. Even now, the old tax regime is applicable. This is the extract of Finance Act 2020. The new tax regime shall be optional for the taxpayers. In Finance Act 2020, for the first time the new tax regime was introduced, they said the new tax regime shall be optional for the taxpayers. An individual who is currently availing more deductions and exemptions under the Income Tax Act may choose to avail them and continue to pay tax in the old tax regime and continue to be there. Now, in Finance Act 2023, they said we are making the new tax regime as the default tax regime. However, citizens will continue to have the option to avail the benefit of the old tax regime by opting out from new tax regime to the old tax regime. So this is the current status of the old tax regime. Let's quickly spend what are the slab rates and the tax rates that were applicable. In case of old tax regime, this was the chart that we had. Up to 2.5 lakh, it was nil. 2.5 lakh to 5 lakh, it was 5%. 5 lakh to 10 lakh, it was 20%. And in case of above 10 lakh, it was 30%. So this was the rate of tax that was applicable to majority of them, being nil for up to 2.5 lakh, 5% from 2.5 lakh to 5 lakh, 5 lakh to 10 lakh, it was 20%, and above 10 lakh, it was 30%. Now, having said this, we had the variation of this for senior citizens and super senior citizens. Who are senior citizens? Anybody aged more than 60 years is called as senior citizen, but less than 80 years. But anybody aged more than 80 years is called as super senior citizen. What is the difference? In the normal category, everybody used to get 2.5 lakh nil. But in case of senior citizen, this 2.5 lakh is increased to 3 lakh. And in case of super senior citizen, this 3 lakh has been increased to 5 lakh. Thereby to say, in case of senior citizen, they need not pay tax up to 3 lakhs. In case of super senior citizen, they need not pay tax up to 5 lakhs. Rest all continues to be the same. So here 2.5 to 5 was 5%. Here it will become 3 lakh to 5 lakh, 5%. The other two categories, 20% and 30% remain same. Here also 20%, 30% remain same. That is from 5 lakh to 10 lakh, it is 20%. About 10 lakh, it is 30%. So there is no difference in terms of the further tax applicability rates in case of senior citizens, super senior citizens, and the regular assessees. But moving further, we had the new tax regime. What was the new tax regime that had come into picture? So this is the new tax regime 1.0. They earlier, if you see here, we had only three slab rates or three tax rates that was applicable. What were the rates that were applicable? Applicable 5, 20, and 30%. Now we have six tax rates. They have divided this into further categories to make into six tax rates. So new tax regime said that up to 2.5 lakh, new tax regime 1.0 said that up to 2.5 lakh nil. Thereafter, every 2.5 lakh, if you see here, every 2.5 lakh, there is a increase, 2.5 to 5 lakh, 5 to 7.5, 7.5 to 10 lakh, 10 lakh to 12.5, 12.5 to 15 lakh. Every 2.5 lakh, there is an increase of 5% tax. If you see here, 0 to 5, 5 to 10, 10 to 15, 15 to 20, 20 to 25, and then onwards, the maximum rate above 15 lakh is 30%. Above 15 lakh, it becomes 30%. Thereby, this was the new tax regime which was introduced with six different rates. Now here in new tax regime 2.0, that is which is applicable from financial year 23-24 onwards, they made a little changes, subtle changes. This six tax rates has been reduced into five tax rates. Now they have made, instead of 2.5, they have made 3 lakhs as the benchmark. Okay. So every 3 lakh, there is a change in the slab rate. Up to 3 lakh, there is nil. So 3 lakh to 6 lakh, the tax rate is 5%. 6 lakh to 9 lakh, 10%. 9 lakh to 12 lakh, 15%. 12 lakh to 15 lakh, it is 20%. Then there is an increase of 5% everywhere. Now here above 15 lakh, there is an increase from 20 to 30%. Earlier, it got divided till 15 lakh, 25%. So then above 15 lakh also got increased by another 5% from 25%. Here, it got increased from 20 to 30% directly. Up to 15 lakh, it is taxed at 20%. Up to 15 lakh, it is taxed at 20%. So what we need to remember now onwards, we need to remember the new tax regime 2.0. That is what is applicable for financial year 23-24 onwards. So thereby new tax regime 2.0 is applicable. Along with this anything might be applicable. So this or this default regime. So default, this tax rate will become default. This will be applicable, but alternatively, this old tax regime will continue to be applicable for those who opt out from new tax regime. Somebody who opts out from new tax regime under new tax regime 2.0, then they will be enjoying this earlier tax rate. They will be enjoying the earlier tax rates. So this is the scenario for old tax regime, or the slab rates or the tax rates that were applicable for the old tax regime versus the new tax regime. So let's quickly see how to compute the taxation under new tax regime. How is total income computed under new tax regime? That means there are four clauses which we need to take off. That is the first one, without any exemption deductions listed under clause 1. What are those deductions that we will see chapter wise? Clause 2, without set off of carry forward of losses attributable to deductions referred under clause 1, or unabsorbed depreciation attributable to additional depreciation under section 32 subsection 1 clause 2a, or house property loss with any other head of income. Earlier, house property in old tax regime, the house property loss can be adjusted against other heads of income up to 2 lakhs. Now that they have done away under the new tax regime. Depreciation claim under section 32, that is except 32 subsection 1 clause 2a, to be determined in the prescribed manner. So depreciation claim, there are certain changes and restrictions they have brought in. Clause 4, without any exemption or deduction for allowance or perquisites provided under any other law for time being in force. So these are the four clauses. Keeping in mind, one has to compute the tax liability or the total income under the new tax regime. Let's quickly jump into chapter wise or the head of income wise. Under salary, what is allowed, what is not allowed under new tax regime, and what is allowed under new tax regime. So under salary, what is not allowed? What is not allowed? Let's quickly focus on what is not allowed under new tax regime. The LTA, leave travel allowance, under section 10 subsection 5 is not allowed. House rent allowance under section 10 subsection 13a is not allowed. Certain special allowances under section 10 subsection 14 like helper allowance, research allowance, education allowance is not at all allowed. Standard deduction of rupees 50,000 not allowed under new tax regime 1.0. That means under new tax regime 2.0 they have allowed this standard deduction. So daily allowance to a member of parliament or a state legislature is not allowed. Deduction of entertainment allowance from salary received from government. Earlier, there was section 16, subsection 2 or clause 2, which was giving deductions under entertainment allowance for government employees, which is not allowed under new tax regime. Deduction of professional tax, that is section 16, subsection 3, which was the third deduction under the salary chapter, is now not allowed. Meal vouchers, not allowed. These are all no to deductions, or these are the things that one has to forego a person who is earning salary income. Now, moving further, what is allowed under salary deductions in terms of the new tax regime? Like I said, under new tax regime 2.0, standard deduction 50,000 is allowed. Transport allowance granted to Divyang employee to meet expenditure for commuting between place of residence and place of duty is allowed. Divyang employee means somebody is physically challenged. Okay, only for them it is allowed, not for anybody else. Conveyance allowance to meet the expenditure in performance of duties of office. This is not, there is no clarity. What are the star marks that I put for the next 3 points? There is no clarity. Either they have not restricted or specifically they have not allowed to claim. Any allowance granted to meet cost of travel on tour or transfer, daily allowance to meet ordinary daily on account of absence of regular place of duty. So these are the 3 things which they have not given expressly allowed or expressly not allowed. As of now, it is considered as allowed. Exemptions under voluntary retirement scheme under section 10(10)(c), gratuity under section 10(10), and leave encashment under section 10(10)(AA). All these are allowed. There is no restriction on these things under salary chapter. Moving further, in case of house property, interest deduction under section 24B on housing loan in respect of self-occupied property is not allowed in case of self-occupied property. Earlier, up to 2 lakh deduction could have been claimed in terms of house property. Now that is not allowed. But in case of let out property, allowed. Interest under section 24B on housing loan in respect of let out property or deemed let out property is allowed. There is no restriction. So what is a change between old tax regime versus new tax regime? It is the interest on self-occupied house property is not allowed. Moving further, in case of the profit and gains from business or profession, what is not allowed? Let's quickly look into what is not allowed. Any exemptions under section 10AA, that is SEZ exemption, is not allowed. And then section 32(1)(2)(a), additional depreciation is not allowed. Only normal depreciation is allowed and additional depreciation is not allowed. Any investment allowances like 32AD, 33AB, 33ABA, 35, scientific research is completely ruled out. No exemption or no capital expenditure is allowed. Only the revenue expenditure is allowed. Capital expenditure on plant and machinery and research and development expenditure, and that too they were giving prior to the research commencement. 3 years prior to the research commencement was allowed. All of that is not allowed under new tax regime. Section 35CCC, agricultural extension project. Now, all these things are something in terms of specifically that was available under old tax regime will now continue, will now not be allowed in the new tax regime. What is allowed? All other permissible deductions under section 30 to 44 is allowed, and depreciation claim is restricted to 40% of the WDV. Depreciation claim is restricted to 40% of WDV, and this is yet to be extended to new tax regime 2.0. Now in 2.0 it is not extended, in 1.0 it was there. They'll have to extend that depreciation claim. Now, in terms of the income from other sources, what is not allowed? Deduction up to 15,000 from family pension under section 57(2)(a), not allowed. Only under new tax regime 1.0. In new tax regime 2.0, they're allowing this. Deduction permissible under section 57, except related to family pension, everything else is allowed, because family pension is something that they said not allowed only under 1.0. And deduction up to 15,000 from family pension under section 57(2)(a) allowed only under new tax regime 2.0. Now, these are the exemptions and deductions in terms of the head of income, but in terms of deductions, that is chapter 6A deductions, no deductions is allowed. Entire deductions is ruled out. No deductions is allowed. Deductions other than those specifically allowed. Whatever is allowed specifically, only that is allowed, except that whatever we have 22, 23 deductions, nothing is allowed. What is allowed is additional employee cost under section 80JJAA, employer's contribution to NPS under section 80CCD subsection 2, and contribution to Agnivir Corpus Fund 80CCH subsection 2. Only these 3 deductions are allowed. Apart from this, nothing else is allowed. ATC, ATD, ATE, ATG, ATU, ATP, Nothing is allowed. 80IA, 80IAB, 80IAC, income-based deductions, expense-based deductions, certain deductions, nothing is allowed except only three. You need to remember only these three for new tax regime: 80JJAA, 80CCD subsection 2, 80CCH subsection 2. What is 80JJAA? Additional employee cost incurred, 30% of that is allowed. Certain pertaining to certain points being met. Employer contribution to NPS is allowed under Section 80 CCD2, and contribution to Agnivir Corpus Fund is allowed under Section 80 CCH subsection 2. Now, what is the procedure to claim? So these are the how to compute. What is the procedure? We know that in terms of the new tax regime 1.0, it was option to opt into the new tax regime. In case of new tax regime 2.0, exercise option to opt out. Opt out is done. So person having income from business or profession on or before the due date specified under section 139(1), options once exercised shall apply for subsequent years. Here, other than income from business or profession, along with ROI to be furnished, election of opt-in or opt-out for every assessment year is available. For business or profession, they will fall under the new tax regime. Other than income from business or profession, they can switch in and switch out. But in terms of business or profession, they'll have to be under the one regime. They cannot keep on changing from one tax regime to the another tax regime. They'll be continuing to get only one option to exit. Once they exit, they don't get option to come in. So this is the methodology in which the opt-in, opt-out will work under new tax regime 1.0 and 2.0. Now, quickly, let us see certain case studies in order to see how the calculations of income under various sets of income work around. Okay. Before that, let's see the break-even analysis in terms of the individuals and under new tax regime and the old tax regime. So break-even analysis for individual other than senior and super senior citizens, that is individual person. How do we select? If total income is this much, that is 5 lakh, 6 lakh, 7 lakh, and deductions is 0, 1 lakh, 2 lakh, 2 lakh 37, 2 lakh 62, 3 lakh 12, and 3 lakh 75, different options are taken. If I have an income of 5 lakh and if I have deductions of 0, there is no difference. It is same. Old tax regime or new tax regime will be same. No problem. If I have 6 lakhs of income and if I have 0 deductions, then new tax regime is the best regime. Okay. If I have 6 lakhs of income and 3,75,000 of deductions, then it is same. Old tax regime or new tax regime, both are same. Similarly, if I go here, 9 lakh of total income and 3,75,000 of deductions, then you will get old tax regime of beneficial. Old tax regime of beneficial. If you see in this kind of chart, majority scenario getting benefit under new tax regime. And in some of the scenario, only around 10 scenarios, it is old tax regime is beneficial. Otherwise, it is either same or new tax regime is more beneficial. Higher the income, lesser the deduction, new tax regime is beneficial. Lesser the income and higher the deduction, then old tax regime is beneficial. Otherwise, the new tax regime is going to be the future and they will slowly be done away with all the exemptions and deductions. So this is the flow chart or in terms of the break-even point. Now, quickly, let's take this example in terms of understanding how the calculation will apply and impact. Mr. Ram is a 62-year-old executive director employed with B Limited. His income and incentives for 23-24 are tabulated below. So gross salary is gross salary other than car perquisite and in employer NPS contribution is 6 crore 50 lakhs. Allowable house rent allowance is 75 lakh. Allowable leave travel concession is 2 lakh. Company has given a leased car of 1200 cc and this is the used partly 75,000. The amount is 0. Allowable conveyance allowance is 2 lakh 50. Allowable helper allowance is 3 lakh 60. Contribution to NPS by B Limited is 14 lakh 50,000. Interest under NPS is 2 lakh 25 as on March 31st, 2023. Taxable is so much. So the taxable interest is 1 lakh. That is 2 lakh 25 out of 2 lakh 25. Payment of professional tax is 2,500. The other income in terms of other sources, income from other sources, savings and fixed deposit is 1,30,000 and receipt of family pension is 1,25,000. Receipt of family pension is 1,25,000. Interest on PPF, rupees 2,50,000 credited on March 31st, 2023 is 2,50,000. Contribution to PPF by Mr. Ram is 50,000. Contribution to NPS by Mr. Ram is 14,50,000. Payment of Mediclaim is 50,000. Interest on loan for purchase of an electric vehicle is 2 lakh. Donation eligible for deduction is 1,20,000. So these are all information of deductions and certain exemptions that he has. And in terms of exemptions here, a lot of things are there. So let's see in terms of what is the question. Okay. What is the thing? Mr. Ram wishes to know whether he should opt out of new tax regime or should he continue to be under old tax regime. So with this information, let's quickly analyze. So old tax regime is on the left-hand side and the new tax regime is on the right-hand side. So the gross salary continue to be same, old tax regime, this will not change. So we are adding the car perquisite, that is 8,800 into 12 for the car and 900 rupees for the driver. So total 2,700 into 12, 32,400 as a car perquisite. Employer contribution to NPS, entire thing will be added back, 14,50,000. Then perquisite under section 17(2), employer contribution to NPS in excess of 7.5 lakh. So that is, he had contributed in excess of 14.5. So that is 7 lakh, 7.5. Perquisite under section 7(2), created interest on excess contribution to NPS, 1 lakh. Now these are all common thing, there is no change. Now comes the allowances, less. Leave travel concession, not allowed under new tax regime, allowed under old tax regime. HRA, not allowed under new tax regime, only allowed under old tax regime. Conveyance, not allowed under new tax regime, allowed only under old tax regime. Helper allowance, not allowed under new tax regime, allowed under old tax regime. The conveyance performance of duties is allowed. Okay. Now, when I say only conveyance, it is not allowed. But when performance of duties, that is for the purpose of office duty, then it is allowed, 2,50,000 under old tax regime and new tax regime. Standard deduction allowed under both new tax regime because now we have new tax regime 2.0. PT, professional tax 16.3, it is allowed under old tax regime, not allowed under new tax regime. By way of this, income from salary is 5 crore 89 lakh under old tax regime and 6 crore 69 lakh under new tax regime. Interest earned on savings and fixed deposit, add both. Receipt of family pension, add both. Deduction under section 57(2)(a), deduct 15,000. Interest on PPF, add. Less exempt under section 1011, deduct. So both these exemptions are available for both. This is income from other source of 2,40,000. So gross total income will become 5 crore 91 lakh and 6 crore 72 lakh. Now, having discussed this, so let's see what is the further computation. From the gross total income of 5 crore 91 lakh, then we have Mediclaim deduction, allowed under old tax regime, not allowed under new tax regime. Interest, that is 80 EEB, maximum 1,50,000 is allowed under section old tax regime, not allowed under new tax regime. Donation, allowed under old tax regime, not allowed under new tax regime. Interest, allowed under old tax regime, not allowed under new tax regime. And under ATCCD, 1,50,000, whatever we have ATC deductions, that is not allowed under new tax regime. Additional deduction of 50,000 not allowed under old new tax regime and allowed under old tax regime. Employer contribution 80CCD2 allowed under both. This is allowed. This is what we said. 3 deductions are allowed. 80CCD subsection 2, 80CCH Agnivir Corpus Fund donation, and we have the employer contribution to NPS. Apart from that, nothing is allowed. So by this, there is 19 lakhs of deductions versus 14 lakhs of deduction under old tax and new tax. Thereby, the net total income out of the 5,91,000, we have now 6,11,000, 31,000 and 6,86,000, 72,400. So this is what is the net amount of income. The tax on that will amount to 2 crore 58 lakh versus 2 crore 63 lakhs. When you compute, you get 2 crore 63 and 2 crore 58. So whichever is lesser, old tax is the beneficial. Old tax regime is beneficial. So you should not continue, or you should not opt out of old tax, or you should not opt in to new regime. So you should continue to be under the, or you should take the benefit of old tax regime. You should take the benefit of old tax regime. Okay, so this is old tax regime versus new tax regime in terms of the salary income. Moving further to see in terms of the house property, how does the calculation look? Mr. Mohit, aged 45 years, has income from salary of rupees 1.5 crore in financial year 23-24. He owns 2 house properties. H1 is self-occupied by Mr. Mohit. H2 is let out by 4,50,000. H1 and H2 were acquired from borrowed capital. The loans are still outstanding. During the year, Mohit has acquired house 3 from borrowed capital. H3 remains unoccupied. That means it becomes deemed let out property. Notional NAV is 1,50,000 per annum. So H1 is self-occupied. H2 is let out property. H3 is deemed let out property. House property loss from self-occupied property brought forward from earlier years is 4 lakh. Basis the above, Mr. Mohit is evaluating new tax regime versus old tax regime. Kindly compute and advise. What we have the solution here is to see as follows. So income from salary will be same, 1 crore 50 lakh, 1 crore 50 lakh. House 1, house 2, first we'll have to make the calculation. So in case of self-occupied property, house 1, net annual value will be nil. Deduction under section 24 shall be nil. Interest on borrowed capital will be 5,20,000. So that out of 5,20,000, 2 lakh can be carried forward and 2 lakh will become the minus income from house property. Similarly, let out property 4,50,000 is the income. Out of that 30% is the standard deduction. 2 lakh is the borrowed capital. So the income will become 1,15,000. Deemed let out property, allowable interest is 2 lakh, and then this becomes deemed let out property. So we have computed here, and 45, 5,50,000, 5,50,000, and then the negative will become 4,45,000. So now, in case of house 1, it is nil. We cannot claim under new tax regime. Self-occupied property interest is not allowed. In case of house 2, we can continue to claim. So entire thing is allowed. Both are same. No problem. So the difference is this 2 lakh. The benefit that I was getting in self-occupied property is not allowed. So income from house property will become minus 5.3 versus minus 3.3. And inter-head set off of house property loss of up to 2 lakh. This loss could have been set off up to 2 lakh under old tax regime. It is not allowed under new tax regime. So net effect, we will get 1 crore 48 lakhs versus 1 crore 50 lakh. And carry forward of house property losses under section 71B. Earlier, we had the 3,30,000, which was the loss, or brought forward house property loss to be set off and carried forward. So 4 lakh is the brought forward loss. Out of that, 3,30,000 can be set off because 5,30,000 is the total loss. 2 lakh is adjusted during the year. 3,30,000 will be adjusted from the brought forward loss. But in the new tax regime, this is not allowed. This is not allowed. Thereby, which is going to be beneficial. So the beneficial amount or the beneficial regime is going to be old tax regime under the house property if you have losses. So this is the next case study that we had to discuss. And then in terms of the depreciation, Mr. Sham is a sole proprietor engaged in the business of manufacturing boxes. Following are the few particulars provided by him. For assessment year 23-24, Mr. Sham is deciding to opt for new tax regime 1.0. And further he proposes to purchase and put to use a new plant and machinery on July 1st, 2023, 8,50,000. So additional depreciation is not given under new tax regime. So this is the information given. Net profit before depreciation 50 lakh and 65 for assessment year 23 it is 50 lakh. Assessment year 24-25 is 65 lakh. Opening WDV of plant and machinery is 7,50,000. Unobserved depreciation out of that normal depreciation is 1,25,000. Additional depreciation is 3,75,000. So this 3,75,000, which is unobserved depreciation of additional depreciation, will not be allowed under assessment year 24-25. Mr. Sham wishes to understand the impact of new tax regime and 1.0 and 2.0. Because if you see here, what this is assessment year 23-24. Here we have 1.0. From assessment year 24-25, it becomes 2.0. So let's quickly see what is the impact of new tax regime 1.0 impact and 2.0 impact. If you see here, assessment year 23-24, new tax regime 1.0, assessment year 24-25, 2.0. First, let's do a depreciation calculation. Opening WDV 7,50,000, purchases, nothing is there. Additional purchase, additional depreciation of 1920 to be added back because you're not allowed to claim under new tax regime. WDV available is 11,25,000, normal depreciation 15%. Additional depreciation not allowed. So closing WDV will become 9,56,000. Under new tax regime 2.0, he has purchased 8,50,000. Additional depreciation adjustment need not be done. WDV available for this 9,50,000 became the opening balance. From there, you're taking. So additional depreciation adjustment is already done in 23-24. You need not do here. Thereby, WDV is 18 lakh 6,000. You get the normal depreciation of 2 lakh 70. So WDV will become 15 lakh 35. So net profit before depreciation is 50 lakh and 65 lakh. So depreciation is 1 lakh 68 750 and 2 lakh 79 38. So you reduce these two. Net profit will become 48 lakh 31,000, 62 lakh 29,000. Earlier, you used to get the set off of normal depreciation of 1 lakh 25,000, which is now not available under new tax regime 2.0. So this is the difference between 1.0 and 2.0. Now it becomes 47 lakh 6,000, 62 lakh 29,060 in terms of the new tax regime 1.0 versus 2.0 under depreciation provisions. Moving further in terms of the last case study that we have in terms of the adjustment of losses, we said that you'll have to forego in terms of the set off of losses. So Mr. Anand wants to determine whether he should opt out of new tax regime in financial year 23-24, that is assessment year 24-25. The relevant details for computation, of income and income tax are as under. So income from house property is 16 lakh, profits and gains business is 10 lakh, long-term capital gain on sale of flats is 23 lakh. Brought forward losses, he has SOP loss of 1 lakh 85, let out property loss of 75,000, business loss not attributable to section 115 BAC2 is 1 lakh 25, business loss attributable to 3512 is 2 lakh, business unabsorbed depreciation is 50,000, normal depreciation is 80,000, long-term capital loss is 4 lakh. All of this loss is there. Now under old tax regime, all this is allowed. Under new tax regime, it is not allowed. So under new tax regime 2.0, we what is applicable. Let us quickly see in terms of the provisions that are allowed in terms of old tax regime and new tax regime. So should he opt out of new tax regime or should he continue under new tax regime? Because under financial year 23-24, new tax regime will become the default. Now, if you see here, income from house property is 16 lakh, both the places same. Profits and gain from business or profession, 10 lakh, both the places same. Long-term capital gain, 23 lakh, both the places same. Now, gross total income, 49 lakh. When you add all these three, you will get 49 lakh under both the regimes. Set off of losses allowed against house property. Self-occupied property is not allowed under new tax regime, only allowed under old tax regime. Loss from let out property is allowed. So both 75,000 is allowed. Business loss not attributable to 115 BAC. That means both the places it is allowed. And in case of business loss attributable to section 3512, that is research, that is allowed only under old tax regime, new tax regime not allowed. And unabsorbed normal depreciation allowed under both the regime. Only additional depreciation is not allowed under new regime. Long-term capital loss allowed under both regime 4 lakh, 4 lakh. Thereby, total losses eligible for set-off is 11 lakh 15,000 under old tax regime. Under new tax regime is 6 lakh 80,000. Net taxable income will become 37 lakh 85,000 under old tax regime, 42 lakh 20,000 under new tax regime. Thereby, these two losses will get lapsed and this will get added to the block. Additional depreciation will get added to the block, which we saw in the previous problem. And in this, the loss will get lapsed. So net taxable income on this total tax liability will become 7 lakh 88,320 and 8 lakh 7,040. So there is around 20,000 of tax difference. Because of that, he need to opt out of new tax regime and go for old tax regime. So these are the case studies that we had today to discuss in terms of the old tax regime and the new tax regime. So like I said, this will become the break-even point analysis for you in order to see which is more beneficial, which we did in certain case studies, which we have discussed today. So this is the paradigm shift of old tax regime to new tax regime and new tax regime 1.0 to 2.0. So with that, we'll sign off for the today's live session and thank you all. Let's meet again quickly.